All right, now we begin our last piece of the puzzle of corporate finance, our third and final principle involving the dividend decision. Split into two parts, and this will round up the course. So, here's something that should be becoming obvious. Remember that every financial decision is intertwined with other financial decisions. It's no less the case here with dividend policy. It's affected by your investment and your financing decisions. And dividend decisions can affect the investment and the financing decisions. So analyzing dividends is actually part of analyzing the whole company because of the little feedback effects, as this is trying to point out. Some basic facts. Most companies in most years pay out what they did from last year as dividends. So there's this stickiness notion. Among firms that change their dividends, the increases are a lot more common than the decreases. Now, if there had been a quarter in a year that should have shaken up the policy of leaving dividends unchanged, it should have been the last quarter of 2008 when you had a broad market collapse. There would have been fears of credit crisis and so on. You have this mountain of bad news, and even in the face of that, more companies increased dividends than cut them or suspended them. Dividends tend to follow earnings, a key idea. They don't lead them, and they're not contemporaneous. So in other words, you don't expect a company to pay out more dividends if their earnings go up. If their earnings go up a couple years in a row, then maybe. If they've gone up 3 years in a row, say earnings are up and then they're up a second year and they're up a third year, then the odds of getting the dividend adjustments are definitely going to be improved. If you looked at this in 2003, really the first time in decades, the tax rate on dividends got cut to 15% to match the tax rate on the capital gains. Now, how firms responded in their dividend policy is kind of a good test of the tax effect. More firms initiated dividends in 2003 and more dividends were paid, but the effect is actually somewhat muted. Stock buybacks were still overwhelming in comparison to dividends. So the lesson to this is that the taxes are affecting dividend policy, but they're not a key determinant. In the last quarter of 2012, there was this fiscal cliff looming, and companies paid out a large amount of special dividends in anticipation of that fiscal cliff. Here we have stock buybacks, a trend that's accelerated through the 1990s, and it's explained really by, I think, three things. First off, you have an increase in the volatility of earnings at companies, making the dividends much more difficult to maintain. You also have an increasing proportion of investors who really are there for capital gains. And then, managers are being compensated more and more with options like stock buybacks. And, paying out dividends can tend to lower stock prices, and that's not something that managers are going to benefit from. Here, looking at it across countries, there are four basic notions to watch out for. There's differences in the stages of growth across countries. High growth companies tend to pay out less of their earnings. Say for Japan, that had pretty high expected growth, 82 through 84, faster growth than other G7 countries. It paid out smaller amounts of its earnings in the form of dividends. Secondly, the differences in the tax treatment will matter. Dividends are doubly taxed in the U.S., but some countries provide some partial protection against the double taxation. Third, you have differences in corporate control. Many large publicly traded firms, of course, have a strong separation between ownership and management. Now, when that occurs and the stockholders have, let's say, little control over managers, the dividend payouts are going to tend to be lower. Now, managers, who are left to their own devices, try to accumulate cash. Russia is a good example. It has a terrible corporate governance system, and the dividend payouts there on average are less than 10% in 2009. Fourthly, stock buyback restrictions are key. Non-U.S. companies in earlier periods really faced strong stock buyback restrictions. In most of the emerging market kinds of companies, the dividend payout ratios are much lower. They face higher growth, and you have much more power of the income management in these kinds of companies. All right, now that we've got some basic survey down, let's look at dividend policy by measuring it. So these are the two most common measures of a dividend. Both of them focus on traditional dividends. You can modify them by stock buybacks, not a big deal. The median payout ratio runs 20 to 25% for the U.S. firms that do pay dividends. On a global basis, it's much higher, 35 to 40%. And it turns out, though, more firms do not pay dividends than those that do pay dividends. And in the last few decades, the number of non-dividend paying firms has been moving upwards. But you do have some interesting outliers. You have some firms that have a dividend payout ratio of more than 100%. That sounds irrational, but let's say you have a firm that has a bad year in earnings, and they expect the earnings to bounce back. So what happened here is they pay dividends based on normalized earnings, sort of on a payout smoothing kind of policy. You also have very stable firms that might have little capital expenditures and a large depreciation amount. So in that case, you have cash flows which really vastly exceed their earnings. And what's happening here are firms that are gradually liquidating themselves. And then in the last case, let's say there's some firms that are under-levered, so they're paying more in dividends than in earnings, and they're funding their difference with new debt, thus increasing their debt ratios. If you looked at stuff, here again, a trend pretty similar to what we've seen in the last 2 decades. Right? Dividend yields for firms increasing across the board. In 2009, dividend yields shot up, but not because of dividends, themselves. It was more like, hey, stock prices decreased, and as a result, constant dividend payments were more proportionally generating high yields, right? And in 2010, you had this drop again as stock prices rebounded. The bottom line is you got volatility in dividend yields, and that's caused more by the denominator, which is the stock price, rather than the numerator, which is the dividend amount, right? You can assess dividend policy looking at a firm in its life cycle. Pretty straightforward. So you see firms, as they grow and mature, their capacity to generate excess cash flows increases, and thus they're going to tend to pay dividends as a result. And this is a little bit of backing for the life cycle theory. The evidence here is on U.S. firms, and we're categorizing these on expected growth in earnings. So we see that as their earnings growth goes up, dividend yields and payout ratios also increase. Now, in terms of our cases, look at this. Other than Baidu, these companies are paying dividends from our case studies. The payout ratio is low for Disney and Tata, and see it's more than 100% for Vale. That probably is based upon an expectation that earnings are going to bounce back. And Deutsche, probably the same reason. You had this financial catastrophe with the belief that earnings are going to rebound. The low dividend yield for all the companies other than Vale indicates that investors are looking for price appreciations. And they're not really truly relying on dividends to examine the reasonableness of the value of the stock they hold. There's 3 schools of thought that run here. They span a spectrum. You have firms which increase, decrease, or do nothing on dividends, And of course, you can find justification for any one of those particular stances. And keep in mind, there's a little bit of truth in each of these schools of thought. So the way to establish our sensible dividend is to extract what makes sense from each school and bring it all together into a composite analysis. So here's the balanced viewpoint. And keep in mind that these are propositions that are not really about dividends, but about returning cash to the owners of a business. So we're just being a very straightforward, common sense, sort of umbrella kind of approach here. Now, in practice, remember, firms that want to give money back to their stockholders can do it by paying dividends or through the stock buyback. Now, dividends don't matter is the Miller-Modigliani hypothesis. It says that, right, dividend policy is irrelevant. Generally, it works like this. Firms that pay too much in dividends lose value because they can't take the value-creating projects that they should have taken. So in our MM world, that cost is eliminated, right, by just assuming the firms can raise the capital to take these projects on. Investors who receive dividends often face a much larger tax bill than those investors who would get capital gains. So this is eliminated in the MM world by assuming there's no tax disadvantage associated with these dividends. So the intuition here is that the MM world, right, or MM proposition is arguing that your total returns on stock are unaffected by dividend policy. So let's see here. I'm just going to double check something. I'm going to keep going briefly, right? So you have the dividends are bad school. This is generally true in the U.S., not so true in other markets. A good example is in the UK, investors are allowed to offset the corporate tax they pay on their dividends against their other taxes. So when that happens, right, there's potentially the dividends granting a tax advantage for certain investors in terms of relative to capital gains. You do have some markets where capital gains are not taxed at all, and you have some where neither capital gains nor the dividends are taxed in these, amazing tax haven types of countries. Now, the tough question to answer is whether stockholders in your firm specifically pay higher taxes on dividends or on cap gains. A way to deal with this is to look at how the stock price behaves on the ex-dividend day to get our answer. So there's our setup. Imagine you have a market that is stable. So the idea is you got the cash flows before you sell should be equal to the cash flows after you sell for most investors in the firm. Or you could think of it as from the point of view of the median investor. So if the cash flow from selling before was greater than the cash flow from selling after for a median investor, the market would collapse because everyone's selling before the ex-dividend day, right, pushes the stock price down to minimal value. And if the cash flow from selling after was greater than otherwise, then everyone would be holding through the ex-dividend day, and then they would want to sell after. So any difference in your tax status actually is going to mean that you're going to find a profit opportunity for the investors whose tax status is very different from the median investor. The intuition is what's really key here. The equality holds in an equilibrium for the median investor in the firm to be indifferent between selling before and selling after. So what we do is look at the price behavior on the ex-dividend days to get a snapshot of the differential tax rate the investors have in the stock in terms of what they face if they get dividends versus what they would have to pay if they got cap gains. So the idea, right, is if the price drop is smaller than the dividend, the median investor, we could argue, has a particular tax rate on dividends higher than the tax rate on capital gains. If the price drop is greater than the dividend, then the median investor pays more taxes on cap gains than he does on dividends. Now, if they're equal, the median investor is actually, facing this tax rate similar or not paying taxes at all. And the empirical evidence shows a couple of interesting points. So as the difference in the marginal tax rates narrowed from what it used to be back to 1981, the trend in the ex-dividend day measure has been towards the value 1. So that reflects a greater role played by the pension funds, which are basically tax exempt. Look at the 1986 to 90 period. Here the dividends and the cap gains were taxed at the same rate. Even in that time period, the ratio did not converge on 1. So this is indicating potentially a timing option. Persons are, choosing when they take their cap gain, and you really don't have a timing option on dividends, right? And since you lack that timing option on dividends, they're less attractive, even when you have, right, similar tax rates. This highlights the notion of dividend arbitrage. So let's examine this question. What should you do? You should buy just before the ex-dividend day and then sell after. See, I would profit as long as the transaction costs are less than the difference between the dividend and the price drop. Let's go look at it in terms of a particular example. So one thing of note is that this is before there's transaction costs. And there's this risk that the market might be down sharply on the day of the transaction. So you want to reduce such effects. A successful dividend capture requires that it be done in larger quantities, so you reduce the transaction costs, or you spread the fixed costs of conducting your transaction across a large number of these bets, we'll call them. And you do this across a large number of stocks and across many ex-dividend days, and that reduces your market risk. So there's the story of a pension fund manager in Oregon who was reading about dividend capture and just tried to try it out in a big way. He tried it out on October 19th, 1987, and he lost his job because the whole market collapsed. So when dividends are compared to stock price drops that occur on ex-dividend day, the fallacy is exposed. Okay? It's at that point in time when an investor has a choice between receiving dividends or cashing out on stock to get his higher price. That's the bird in the hand. Or we have the excess cash. That's really a temporary phenomenon. To initiate dividends with cash creates an expectation the firm is going to continue to pay dividends, which might really be an unsustainable policy. See, the stock buybacks give you more flexibility for future actions. That's really an alternative compared to what we could call a special dividend. And look at the cost of raising capital as a factor. If a small firm has excess cash, but it's uncertain about future investment needs, it would be very prudent, right? The managers are going to be prudent holding that cash rather than giving it back to the stockholders. A large firm with a lot of excess cash might want to give back some money. And I mean, they have more access to capital markets, and they're going to tend to want to use a stock buyback. Why should we pay dividends? This is based upon the fact that we see so many firms paying dividends. So there's got to be good reasons to pay them, or say to continue paying them, or to even increase them. And the scholars have looked at a lot of various possibilities. So these are the general ideas that are present in this analysis. So let's look at each one with a caveat. Remember that Class B shares can be converted to Class A shares at any point. So in essence, you're offering investors dividends or the equivalent capital gain. Now the tax rate in this data set, the tax rate vastly exceeded the tax rate on cap gains over this period. So you would expect the cap gain shares to trade at a premium. So whenever the ratio is greater than 1, the Class A shares are trading at the premium against the Class B shares. This data shows over the period Class A shares were consistently traded at a premium of somewhere in the range of 5 to 15%. Looking at Canadian utilities, the same phenomena applies. Conclusions should be restricted to stockholders holding the stock, remember. So for whatever reason, they're preferring dividends to cap gains. I mean, who owns, these kinds of companies, younger or older, richer or poorer persons? Let's say mutual funds or pension funds. Okay. Older, poorer investors and pension funds are big investors seeking high dividend-paying stocks. Clientele-based explanation is very straightforward. Investors buy stocks which have dividend policies that they like. That's a basic idea. It's a self-selection process. And as long as there are sufficient investors in each of the clientele categories, if you have a high dividend or no dividend by itself, that shouldn't really affect value very much. But supply and demand conditions can become imbalanced in the different sectors that we're identifying in terms of these clientele segments. Here's the evidence of investors picking stocks based upon their tax status. So low-income, older investors tend to buy safer stocks that have high dividends. That behavior is actually accentuated when there's a difference in the tax rate between the dividend and the cap gain increase. So you have this implication, right? The clientele effect has weakened in recent years. That's because the tax rates on the dividends and the cap gains have tended to converge. Looking at this situation, given the dividend clientele that I've attracted is unlikely to be swayed by arguments about my investment needs, you might want to try to spin off the media division and then set a dividend policy that's different inside that media division. In that spin-off, the investors that are there would probably prefer cap gains. And those who want the dividends are going to tend to hold the phone company shares. And actually, many phone companies have separately traded their stocks for their wireless arms. One reason is that the wireless business is far more risky and more growth-oriented, and they're going to want to tend to pay out far less dividends in those kinds of businesses. I think I'll stop there, and I'll pick it up